The views and opinions expressed on the following program are not necessarily those of the staff and management of Salem Media of Hawaii.
Welcome to Generations Radio, where the focus is on our seniors and their families. We are here each Saturday afternoon from 5 until 6 p.m., bringing you resourceful information with our radio team of professionals in the field of aging. Stay with us for the next 1 hour as we explore different ways to make life more exciting and meaningful for our extraordinary seniors. Right here on AM 690 The Answer. And now, here is our host and the publisher of Generations Magazine, Percy Ihara.
Good afternoon, everybody, and welcome to Generations Radio. I am Percy Ihara, the publisher editor of Generations Magazine, and this is our radio format of the magazine that come here every Saturday afternoon from 5 to 6. And thank you, Mr. Frankie B, for introducing us here. As you guys know, his show is just before us from 4 to 5, and I always listen to him from my smartphone, actually, when on my way to the studio. Anyway, good afternoon. This is a Saturday, beautiful Saturday here. Today, we're going to have something a little bit unique, different. As a lot of you guys know, that I got involved with Generations Magazine because of my work in the reverse mortgage business, and I have an extensive experience and background in aging. And a lot of my clients would come up to me asking for resources, asking for referrals, asking for information on Social Security, Medicare, Medicaid. And so I did a lot of deep dive research into that over the last 10 years. And that's why we took over the Generations Magazine to make it a resource magazine. But today, still people call me, still email me everywhere I go. I had a golf tournament yesterday asking about the reverse mortgage. So I just thought, well, let's just talk about the reverse mortgage for you on the radio show today. And there's not a whole lot of people very versed in this business in Hawaii, I have to be honest with you. There's very few bankers, very few mortgage brokers, and there's very few people asking more specifically that specialize in the reverse mortgage besides myself, a few other people. But from a financial point of view, from a legal point of view, there aren't a whole lot of specialists in this field. I know our attorneys, Scott Mulkoakani and Steve Inyam, have some background in reverse mortgages with their clients. And today we have our other professional here, Mr. Michael Yee, certified financial planner with Ameriprise. Welcome, Michael, and thank you for coming in. Help us discuss the reverse mortgage product.
Thanks, Percy. The reverse mortgage is a borrowing instrument, and today is just one tool in the retirement planning tool chest, which includes planning for living a long life, and it includes long-term care. So today, because people are living longer and experiencing long-term care more, we need every tool we can use. Every tool in the toolbox, as they say. That's right. That's what I need.
But Michael, as you know, you've been in the business, almost 30 years now? 20?
Yeah, 30.
Years? And you've got the designation, which I always tell people, when you work with a financial planner, you want to have somebody that has a broad experience in financial planning, not just insurance, not just investments, but the broader aspect, and that's a certified financial planner, which you are. So give our audience a little idea what it takes to be a certified financial planner.
Same thing like going to college. I mean, you have to, I had to study and pass 6 separate areas of financial planning. And then I had to take I think it was all day or 4. It's so long ago that I passed it. I can tell you this, that when I did get my professional designation on that day, I was in the room. There was a guy who was a MBA taking the test with me.
Wow.
And there was a certified public accountant. So by my standards, these 2 guys are smarter than me. And 3 of us in there taking this exam. So the funny thing is, I passed the test. The CPA passed the test. I mean, the MBA guy passed the test. The CPA guy failed.
It's not easy. And,
yeah.
and actually
so just because you're an expert in taxes doesn't mean you can pass a financial planning certification.
That is the most rigorous test. And I know you have to take all these classes. And there's actually very few in Hawaii. I mean, we belong to the Financial Planners Association of Hawaii that meets every month. And when you look at the list of certified financial planners, there's not a whole lot of them here. Yeah. Actually, based off of the percentage-wise, I'm not sure exact percentage, but not a whole lot because it takes a lot. But anyway, Michael, thank you for coming in. And what I wanted to do, like I said, talk about the reverse mortgage as an open forum, and not only have it from a mortgage banker perspective, but from your financial background, because Ameriprise one of the largest financial services companies in the United States, let alone the world. And I know you've done a lot of extensive studies as well. And your company also has certain restrictions that you can and cannot do with regard to investing or utilizing the equity of your home. Is that correct?
Right.
So anyway, we want to start off today with actually the reverse mortgage history, right?
Right.
And so what we're going to do is I'll give you a little bit of background. As early as 1963-64 in the United States, the first study on the reverse mortgage was done by Dr. Bing Chen, who actually came to the United States in the early 60s, a little before that. And he was involved with Seattle Pacific University back in the day, and then was commissioned by the Brookings Institution to do a study on planning and resources and for as you get older. Anyway, but the Brookings Institution is a nonprofit think tank out of D.C., and the mission is really to conduct high-quality, independent research based on really facts and their findings. And they talk. Their main goals is to how to strengthen American democracy. So they do cover politics, how to foster economic and social welfare and security among Americans, and also have important aspect of prosperity and cooperation with international systems. But Dr. Bing Chen, who since has retired, obviously, because he did a study in 63, 64, was commissioned by them in 63, 64, and also came back in 1970, and that was, Michael, was the first study of the reverse mortgage and how it can benefit people as they aged.
That's incredible. Somebody had the foresight to see that people are going to live a lot longer.
Well, what's interesting, Michael, is that when he did that research, he found other studies that talked about the reverse mortgage, and it's amazing that he found out it went back to the old days in 1800s in France when they started it, and then he also found in 1961, I believe it was in Minnesota, that in 1961 that let's me go find this to a study here in Dear Savings and Loan in find a study here. Did a loan that would act like just like a reverse mortgage, where they could borrow money and not pay it back, and the interest is added on to the balance of the mortgage. But the main thing, and a lot of people don't realize about the reverse mortgage is, they worry about what the kids are going to get, but they got to worry about where they're going to live the first 20 years, 30 years when they retire, right?
Yeah.
So very important for people to understand. This study for the reverse mortgage was first studied in the 60s and again in the 70s. But Dr. Bing Chen, thank you very much. In fact, we brought him to Hawaii August of 2012 to talk about aging and the financial side of long-term care. Anyway, in terms of, let's go to the misconceptions.
Sounds good.
And what are some of your big misconceptions from a financial planner that you see a lot?
The one I see a lot is I'm going to lose my home.
Yeah, but you could lose your home whether you have a reverse mortgage or a regular mortgage, right?
That's right. And when I see that one, the funny thing our company looks at, let's suppose reverse mortgage is still borrowing money. So whether I had a conventional loan or I had a reverse mortgage, it's still borrowing money. You got to pay back at some time. And so the idea is the worst case scenario would be that imagine if you had debt when you die and the debt was more than the value of your home. It could happen in a conventional setting.
Which has happened the last few years.
Yes. And it can happen in a reverse mortgage setting.
Yes.
So the consequence in the conventional setting is you could be liable for the full amount. So for example, if the loan was $500,000 and the value was $400,000, you're liable for the full amount of $500,000.
Right.
Same example in the reverse mortgage, and again, this is something that everybody should consult a lender, because I'm not the lender. Always involve multiple professionals when trying to make decisions. But same setting, the reverse mortgage, the balance is $500,000, the home is $400,000. You're only liable for the $400,000 up to the value of the home.
Right.
They call that non-recourse.
Right.
is
The only
word.
recourse they have is the house to take back. So actually,
Yeah.
I've done reverse mortgages in California, Arizona, and Las Vegas. And I've gotten calls from people in Las Vegas and Arizona saying, "What do I do now?" Because the market dropped in 2009, 2010, and it was way below. I mean, the Arizona market was at, I think they bought a house for $450,000, and about 3 years later, it was only worth about less than $200,000.
Yeah.
But the reverse mortgage is about $280,000.
Yeah. The other misconception is this. Let's suppose we go the other way now. Same thing. The home's worth $400,000 in a traditional setting. The balance on the home is $200,000. So traditional loan $200,000. The value is $400,000, and you die. Guess what? The heirs got to figure out what they're gonna do about paying the $200,000 back.
Well, first they're going to decide whether they can keep the house or not.
Yeah. So they're gonna make a decision. We're gonna pay off the loan. We're gonna refinance the loan under their own name. Or they're going to sell the home, like you said.
Right.
And so we go to the reverse mortgage where the myth is I'm going to lose my home. Same situation. The balance is $200,000. The options are identical.
Yep. Well, a little bit different. The reverse mortgage, they're allowed about 6 months after the last surviving spouse passes away. Typically, it's 6 months. And a lot of times I've seen where they give them another 3 to 6 months as well. But you got to put it in writing saying, the market's bad or we have a situation with the family, we can't sell the house right away.
So you're saying they give you more time?
Yeah, more time. On a regular mortgage, they want to get paid off right away. See, because that back interest, somebody's got to pay it.
Yeah.
And the homeowner's not going to pay for it. On a reverse mortgage, the homeowner has to pay that because interest is accruing. So a little bit different. You saw some ads and articles in the newspaper in the last couple of months about how they're being foreclosed upon right away. And it was actually the servicing companies that sent out letters immediately. But legally, they get 6 months. And after that, they get another 3 to 6 months. It really depends on the servicer. Obviously, it depends on how much equity is left over. Yeah. But it's really important. People need to understand the difference between a regular mortgage and a reverse mortgage is that on a regular mortgage, you have to make that mortgage payment, including the property tax and the homeowner's insurance.
Yeah.
And that's a requirement. So I always tell people, where you're 50 years old, you got a new 30-year mortgage. How are you ever going to retire? Right? How can a retired person that's 50 and gets a mortgage for 30 years, and if he wants to retire at 65, Mike, what do you tell him? You got still 15 more years on the mortgage.
Yeah. He's so how are you going to do it? Do you have enough money in your nest egg? And if you don't, now you have a mortgage payment that might go 20 years into retirement.
Yes.
And is that mortgage payment going to be the difference between having income or not having income when you reach 85 or 90? Is that mortgage payment going to make a difference when one of you gets ill or needs long-term care?
The biggest question I tell people, Michael, is how does it affect your quality of life?
Exactly.
And can you put a dollar value on quality of life? Really important for people that want to refinance, keep on refinancing. My goal, I've said this many times, when I retire, I'll have my mortgage paid off. And that's our plan. I mean, obviously things can change. And if we ever needed money, we can get a reverse mortgage and utilize the line of credit and the line of credit growth factor, which we'll talk about a little bit later on. So a lot of people have to realize that when you take out a long-term mortgage and you want to retire, that's usually one of the hardest things for them to do. And today, I've been doing this 10 years now. When I first started, everybody was over 75, 80. Today, most of my clients are less than 70 because they want to retire.
Younger.
They want to retire,
Yeah.
but they still have a mortgage payment. It affects the quality of life. So, we'll get into this later on about the back end of what happens when you pass away or the accruing interest, but very, very important. So those are the simple myths. When you pass away, it's the same thing whether you have a reverse mortgage or a regular mortgage. That balance has to be paid off. If there's equity in a home, whether you do a reverse mortgage or a regular mortgage, the remaining equity goes to the heirs of the family. So anyway, I know ARP did a study. We'll talk about that a little bit later on, but there's a misconception that reverse mortgage borrowers use it to fund vacations and other things, right?
Yeah.
What do you see, Michael, out there? Because I know you deal with so many people.
That's not the number one reason. The number one reason is they're running out of money or they need long-term care. That's the number one reason that they start showing up at Percy Ihara's workshop And it's usually there's some kind of crisis going on, and they can see the end of the tunnel. That's when they start.
Yeah. According to the AARP study and some of the independent studies, the two major reasons why people use the reverse mortgage is pay for healthcare insurance. Because if you have HMSA, you have to pay 8%, 20%, right? Mm-hmm. So if you have a procedure, that 20% could be $50,000, $100,000. But more so in Hawaii, we see more people using it for long-term care, to pay for care, because they didn't buy long-term care insurance or they had no plan set up for long-term care. But those are the two major reasons. I think, vacations and buying a new car is way, I think, number 4 or 5 on the list. Yeah. I think college education is very high on the list as well. Mm-hmm. What about you must hear this all the time, reverse mortgage are too expensive, right?
Yeah. I always approach that as, everything has a trade-off. There are no perfect solutions. So, for example, I could go with a home equity line of credit, and we will explore that. And so the home equity line of credit has no closing costs.
Very limited closing costs.
Very limited, yeah. The trade-off is, I said, when we borrow money the traditional way, the condition is pay me now. Mm-hmm. So it means that it comes with a payment obligation. And I was just reading this thing here, like our company writes pieces that I can hand to clients so they can remember.
Ameriprise Financial.
Yeah, Ameriprise Financial. What is the plus and minus of borrowing money this way versus the plus and minus of borrowing money that way? Mm-hmm. So everything has a plus and minus. And what the number one thing they say, you should be absolutely certain that you have sufficient monthly income to service the debt over the life of the loan.
Paying a mortgage payment
and
every
it
month.
says if you cannot, you might lose your home.
Well, yeah. I mean, that's what people don't realize is that if you have a regular traditional mortgage, you have to make that mortgage payment or they're going to foreclose.
Yeah.
I mean, hello.
So there's a plus and a minus in that. I'm not saying one is good or one is bad, but for someone who can make the monthly payments, is the way to go, right?
Yeah, I do recommend that.
If you can make the payments, it's the way to go.
But then I go one step further, Michael. If it's a couple and they can make a payment, it's great. But my next question to the couple is, when one spouse passes away, are you still going to be able to make that mortgage payment?
That's exactly right. And that's why I'm saying that when that happens, if you didn't think that far, that what if one of the two die, now can we still afford the payments?
That's right.
Now what solved the problem? Maybe you picked the wrong tool. You took out a Phillips screwdriver and you needed a flat nose.
Well, usually what I do is when I looked at a husband, because he typically will pass away before the spouse, wife. I said, so you have retirement, you have pension, you have Social Security. How much of your pension carries over to the wife? And the wife looks at dad and goes, yeah, how much do I get when you pass away? Yeah. And you'll be surprised. I'm surprised how many people didn't take a beneficiary amount, because back in the day they needed all that full retirement and they never thought about when he passes away. They didn't do that planning. Yeah. And I'm surprised how many don't get any pension.
See, just like what you're mentioning, when we're making a decision like borrowing money in retirement, that's a big decision. And if we forget that life is uncertain and we don't account for all the what ifs, then it could be the wrong decision in a wrong situation. So I like to have retirement planning be something that we answer the question, if the certainty of uncertainty happens, is this decision going to affect us negatively or positively? The reverse mortgage, I explained, where the traditional is pay me now. The reverse mortgage, a lot of people don't know, is you can pay me now or pay me later. In other words,
right,
if you win the jackpot at Las Vegas and you come home and you tell me, hey, Mike, I won the jackpot at Las Vegas, and then you got a big balance in the reverse mortgage, one of the decisions you can make is you can pay it off just like you would make the same decision on your home equity line of credit.
Because there's no prepayment penalty.
No prepayment penalty. So you can pay it off now or later. So the trade-off might be the initial upfront cost, the benefit in retirement planning, when the what ifs happen, husband dies, you're not worried about, can I make the payments? Right.
Yeah, absolutely.
Which brings one of my stories, if you want me to share.
Yeah, go ahead.
A while back, I had a client, good couple, and they were in their 70s, and they had spent their lifetime raising two beautiful daughters, financing their education, and then now the daughters were grown up and married. And like I say, not everybody has a big bucket of money for retirement, so they didn't have a big bucket of money for retirement. And they were worried that they're starting to spend down their nest egg. And they had home equity line of credit on their home, so they're worried that, is this how my life is going to look? We have to make the payments. We don't have any money left over for lifestyle. And they were worried about long-term care, so they went to a workshop, and they learned that if they give their home away, they can pay for long-term care with Medicaid. So they went and did that, and gave the house to the two daughters who are married. And so they called me up, and I came over to see them one day, and they said, Mike, we solved long-term care by doing this plan so that Medicaid would pay, but now we're still making the payments on the debt. Is this how our life is going to look? It didn't solve where's the money going to come from. And he says, I don't know how much time I have. I have problems with my health. My wife has problems. I want the rest of our life, whatever we have, to be quality.
Mm-hmm.
And so I said, well, like I said before, no solution's perfect. Yeah. But maybe there's another way. So when we looked at the other way, ultimately we ended up switching in back to them. And we ended up doing a reverse mortgage. And I remember the year after the reverse mortgage was put in place, they said, wow, I feel like I got a new life. In fact, I think I'd love to take my wife to Las Vegas. We haven't been able to afford to do that ever since for such a long time. They said, oh, by the way, our car's breaking down. We might have to replace it. Should I wait till November when the thing goes on sale? I said, with your health and your age, are you going to wait for a sale? If it breaks down, you need to buy a new car.
Yeah.
You use the reverse mortgage to do that, right? So they did it in April, I remember. They bought it. The car did break down the same day they bought the car, and they drove. Then I learned some bad news. I learned that one day from a phone call from a close family friend that the husband had an open heart surgery in May, 1 month later, and he went home and then he died. And I was feeling terrible. So I went and I wanted to call. I was expecting grief. I don't know what I was going to hear. And the wife talked to me and she said, Mike, we really want to thank you. Because when my husband went into this surgery, he knew that he might not come out alive. And one of the things that he worried about most was when we had the debt and so on, if he should die, how was my wife going to make the payments on the debt? What will happen to her? Could she live out her life? And she said, we talked about instead about the good times. We talked about he felt secure that she would go on because she'd have no mortgage payments. And the reverse mortgage gave him peace of mind. We could reflect on that. Now, in this case situation as well, as it turned out, one of the daughters got divorced.
I remember that.
Remember that? And if we had gone with the other plan, and the two daughters shared the place, and then the husband got divorced, one of them, now that one half is subject to the divorce.
Yes.
right? So that would have just the solution would create another problem. So as it turned out, the reverse mortgage made it possible for them to keep control, keep the roof over their head, avoid the obligation of making payments on the existing debt. And the wife ended up living much longer, still alive today, and she aged as everyone else does. And eventually, one of the daughters had to, the one that got divorced, moved in with her with the new boyfriend.
She moved back to Hawaii.
Yeah, moved in and took care of mom until the mother got older. And then when the mother got older, the other sister who lives in the mainland said, I'll take over taking care of you. And he said, we got to build you a place at our home because mom wants to be independent. We still had money in the reverse mortgage, so that money was used to both. One, she gave a little bit of money to the daughter that took care of her in Hawaii.
Oh.
Because the reason that daughter got married, was pregnant, was going to have first child. So she said, I want my daughter to have something. Mm-hmm. So gave her a little bit of money. Gave the other daughter the money to build a cottage in the back of her house in Seattle.
Right.
And she moved there. And then they sold the condo, paid off the reverse mortgage, actually cleared it.
Wow.
A little bit pocket change left over. That's what I call a happy ending, a much different outcome. That if they hadn't chosen that path, which is not perfect because they paid the upfront fees, she wouldn't have had the quality of life she did with her husband. He had no idea that his life would end the way it ended.
Right.
But he had the wisdom to know that what do I do about the quality of life? What if I die? Is this how our life is going to end? And what about long-term care? And in this situation, that's a happy ending. I'm not suggesting everybody, but I'm suggesting when the circumstances and the suitability is right, it may be the perfect tool.
Well, what I tell people, Michael, is it gives you all the different options.
Yeah.
When you have a regular mortgage, you don't have an option. You have to make, your only option is make a payment.
Yeah.
And with a reverse mortgage, you can still make a payment like a regular mortgage. You can actually make any payment above $100. And this month you make $500, next month you make $1,000, next month you make nothing. But that gives the beauty of the option. You still have an option to do a regular mortgage later on.
Yeah.
You still have an option to sell it at any time. But and that line of credit is there to be utilized, and a lot of people don't realize our rates are lower than the banks today on the equity line. You know. So anyway, hold that thought, Michael. We're going to take a short break, and we're going to come back talking about the basic guts of a reverse mortgage, some of the product benefits, and we're going to talk about how people today are using the new reverse mortgage with the lower fees. We'll be right back. This is Percy Ihara, Generations Radio.
I'm down for the memory.
Well, aloha everybody. This is Brother Noho for your soul. And when I'm hanging out, I like to hang out with Frank B on his Baby Boomer show on AM 690, The Answer.
Today, more than ever, we local people are living longer than any other state in the Union, with more seniors, baby boomers, and caregivers. Generations Radio promotes the importance to be proactive as we all age. The radio team will focus on issues facing our seniors and their families, finding resources to navigate healthy aging along with financial, legal, and caregiving information. So join Percy Ihara from 5 until 6 each Saturday, right here on AM 690, The Answer. Hello, Frankie B here, your lovely and charming host for the Baby Boomer Show every Saturday from 4 until 5. Be there, or I'll come to your house and rearrange your furniture. Join me, will you? Saturday from 4 until 5 right here on AM 690, The Answer. focusing on the issues facing our seniors and their families today. Here's our Generations Radio host, Percy Ihara.
Welcome back, everybody. We're talking about the reverse mortgage, whether you like it or not. Hopefully, we can give you more information to make that decision. Because we're here at Michael Yee, a certified financial planner with Ameriprise Financial, and I've done several hundred of these. I think I have over almost 1,000 clients in the last 10 years, and I probably counseled several more thousand over that did not do the reverse mortgage. And one thing, Michael, you being a certified financial planner, a lot of my clients, I recommend them seek out a financial planner, and if you have the opportunity, seek out one that's a certified financial planner. And the biggest thing, Michael, that I find out, because I work with a lot of planners, whether they're CFPs or not, is that for yourself and Ameriprise Financial, I'll give you a little plug, you guys really look at the holistic plan of planning, the whole body, the whole life of a person and their family, not just from an investment point of view and not just from an insurance point of view, but the whole plan.
Right.
And that's one thing I respect about all the certified financial planners.
Yeah, whether there are a lot of people who make decisions about borrowing money on their own, and they do it the conventional way. And, it doesn't make a difference if you're going to use a conventional financing or you're going to use a reverse mortgage. A lot of people make the wrong decisions about borrowing money. And borrowing money is neutral now. It can be good or bad. So when you make the wrong decisions because you didn't take it into account the entire picture, like we talked about earlier, what if one of us dies, then you could make a decision that now exposes you to negative consequence, because every decision you make has pluses and minuses, and we have to figure it out in the context of a bigger picture, which is borrowing money has to coincide with covering your basic essentials, your food and shelter for the rest of your life, your lifestyle, uncertainty of long-term care or dying too soon. And borrowing money has consequence for the heirs, legacy. So from all the financial planners out there in the world, our view is you need to look at the big picture in order to make the right decision, the right way to borrow the money. Whether I'm talking reverse mortgage or traditional, when you look at them side by side, relative to all the other human aspects about living too long, long-term care, dying too soon, which one serves you best? That's how you got to do it. In fact, if we done right, as you and I have talked about before, we can pay off the debt.
Well, pay off the debt. If you do it right, then you can also leave some inheritance for your family.
Yeah, sometimes life insurance can solve.
Well, that's obviously another topic, but I have worked with a lot of planners where they look at life insurance, even at a later age, to be able to pay off the mortgage or pay off the debt,
right,
or pay it down. And also, maybe even look at having some inheritance for the family, because life insurance, to me, that's the only product that as long as you pay the premium, you can qualify. You're going to get your money back, and you're going to get a lot more money than you actually put into it. So anyway, we talked about the misconceptions. A lot of people think it's a last resort. To me, it's not the last resort. I've seen so many articles about the last resort, and I've actually emailed a lot of writers about saying it's the last resort. But it has changed in the last year or 2 years with the restructuring of the reverse mortgage, and it's not a last resort now. If people think it's a last resort, they need to sit down with a certified financial planner that has extensive background in utilizing the reverse mortgage, because a lot of planners are not versed on the reverse mortgage. But anyway, Michael, I want to talk about this process and some of the items that people need to look at. And through our list over here, we're going to go here and there about the different items of the reverse mortgage. But for the appraisal, the appraisal is an FHA appraisal, so a little more thorough on the appraisal. We do look at deferred maintenance. We do allow a certain amount of deferred maintenance as long as there's no safety or health issue. We do have a limit on that, so you can give us a call later on or talk to your mortgage banker that specializes in reverse mortgages. Counseling is a requirement, as you know. Yeah. And what do you think? You've had a lot of clients do the reverse mortgage, Bill?
Yeah, the counseling is the best thing to ever happen, because they go through all the steps of did you explore the alternatives? Do you understand how this works? I always what I like about you, Percy, is that you and I always incorporate it's a family thing. So we open it up. We bring,
If we can, sometimes
bring
they
the
don't
kids
want to,
in
but
and all of
yes,
that.
yes.
If they're open to it, and then so everybody understands. We looked at the alternatives and decided that from all of that, is this the best way to go? Remember?
Yeah,
Remember
absolutely.
that? Yeah.
Absolutely. What's interesting now, because the reverse mortgage has changed a little bit, and also counseling has been more thorough. They ask questions twice, about I think 5 or 6 questions twice, to make sure they're still competent. They want to make sure that they don't go and invest any money, and no mortgage loan officer has talked to you about investing the money, specifically annuities, because annuities are good for younger people, but not for somebody over in the 70s or 80s years old. But it's really good, and people don't realize it's a requirement.
Yeah.
Even though they spend a couple hours with me, they say, "Well, I don't need to do reverse the counseling. I know everything about it." Nope. You're required to do counseling, and unfortunately, there's nobody in Hawaii that can do counseling anymore. You have to call the mainland. There's a list of if you want a list of counselors, you can go on the internet, or you can contact me, and we'll give my contact information later on for questions as well. Line of credit. Now, you've experienced this, where most of my clients will set up a line of credit. Mm-hmm. They don't utilize the fixed rate, or they don't take all the money out. Is that probably a good way to?
Yeah, I like that, because then the rule of borrowing is only take the money out when you need it. And if you take out only when you need it, then you're accruing less interest. And the flip side of that is the money that you don't take on the line of credit is growing by something called credit line growth. So it's going to make it possible for the amount of equity we have access to in the home to grow with time. And the more it grows, the more financially secure you become. Because if you use it up all one time, that's it. You shot it all off. There's no more money to borrow out of the home. And now where are you going to go? If you let it go and only use it as you need it sparingly, your family will be happy, you'll be happy.
Well, you never know what's going to happen down the road.
Financially secure. Yeah, again, it's helping to solve the uncertainty, the certainty of uncertainty.
Yeah, there are fixed rate mortgages. We call that a closed-end mortgage, or closed-end line of credit. In other words, the amount of pool of money they qualify for if they use it all. And today it's really different. Today they have to qualify for that. They cannot just take all the money out. Mm-hmm. Because you can only take out 60% of what you qualify for. And that doesn't mean you can take out 60% of the value of the home. There's a lending limit of $625, and then you qualified what they call maximum claim amount, which is reduced by the younger you are. And right now, don't quote me on this, it's just between 50 and 60% of the value of $625. And it's in how much you can borrow is even 60% of that. So people got to realize that it's not utilized to take all the money out and go invest it. I think a lot of the mortgage companies and loan officers were abusing that because they were getting paid for how much they take out. Very, very bad situation. We never recommend them take out any more than they actually just need for daily living, right, or for certain, fix the house up, help the kids with college and things like that. But it's really important that you utilize the line of credit. But what a lot of people don't realize, that let's say you have a $300,000 line of credit. If they only take out $50,000 or $100,000, that's the only interest we're going to charge them on.
Yeah.
So the difference will be, let's say they have $200,000 in a line of credit. They don't touch that money. That line of credit grows, and we call it the credit line growth rate. And that credit line growth rate is the interest rate, which today is we usually use a 2% to 2.25% margin on top of the 1 month LIBOR. And on top of that, it's added on what's called the mortgage insurance, because almost all the reverse mortgages are FHA insured. And that's 1.25%. So let's just say, for fictitious reasons, let's say it's 3%. Let's say it's 2.5%. And then 1.25 on top of that equals 3.75. That's the growth rate. That's also the interest rate and mortgage insurance we charge you. But the growth rate is 3.75. So when a rate goes up to 4 or 5%, that credit line growth rate matches it.
Yeah.
So there's no bank, no credit union that's going to be able to provide that to them. And now it's not interest. And so if a loan officer tells you it's interest, you're making money, they're lying to you, and you better find somebody else. Because I've experienced many of the planners and financial advisors and mortgage people here in Hawaii saying that, and that is not right. It's amazing how many people in the last 10 years I've run into that tell people that, and that is absolutely wrong. If that guy is telling you that, he is actually lying to you guys. So it's called a credit line growth rate. You're not making money. All it means is your borrowing power over time goes up.
And I like that, Percy, because consider the alternative. All other forms of borrowing, you're limited by your ability to pay back. So at some level, you can only borrow so much. The credit line growth in a reverse mortgage guarantees this future access to money that you can borrow, and at no consequence, because if you don't need it, you don't pay for it. If you need it, it's there.
It grows automatically no matter what happens to your age
So
or your
if you don't
value.
need it, you don't pay for that. It's there. All other forms, you're limited. And what's going to happen as we get older is our ability to borrow money is limited by our fixed income.
Well, I've seen situations where some banks reduce the line of credit because one spouse passed away.
Yeah.
But a lot of people don't realize that the line of credit grows no matter what, guaranteed to them. In other words, if the value does not go up, that line of credit still goes up, guaranteed to them. So that's part of the mortgage insurance. So people say, what's the mortgage insurance for? Well, it's a pool of that 1.25 goes into a pool. Unfortunately, right now it's for all FHA loans. So whether it's a FHA loan or a reverse mortgage loan, if there are more FHA losses, which there were, that fund eats up part of that, and that's unfortunate because our FHA reverse mortgage pool is good, and the losses are limited, way less than regular FHA loans. Even though there are people that are close to being foreclosed upon because they don't pay their property tax or their homeowners insurance. Yeah. They say it's about 10% of all borrowers. But another one we talked about earlier was non-borrowing spouse, where one spouse is not 62, or maybe they are 62, but their husband's 70, and people realize that you can get more money if the 7-year-old borrows. So in other words, if you are 70 and your wife is 62 and you're both on the application, we have to use the younger person's age. So I've seen situations where the younger borrower will go off title and the older borrower will stay on because they get more money because maybe they had a larger mortgage balance. But let's say they're 58 years old and they would get the reverse mortgage because they need it, right? But yet that person, 58-year-old, has to come off title. So there has been changes recently where existing reverse mortgages, they had a borrower that was a non-borrowing spouse that were not on title, not on a mortgage. When the older spouse passed away, there's a new thing coming out that they're going to be allowed to stay in the home for the rest of their life. So even though they weren't on title on the mortgage.
That's outstanding. That's like as if we had both of them on to begin with.
Well, there were a lot of fights, arguments. I know ARP threatened a lawsuit, things like that. And so HUD really took a close look at that. And, they said, you know what, you're right. But I'll be honest with you. When I had these situations, we always had the borrower, talk to an attorney to understand the ramifications of them coming off title. Right. They're counseled about that, but nobody thinks about it 20 years later or 10 years later that, we talked to you about it before. Mm-hmm. So it's very important that people realize. But there are no more service fees, monthly service fees on a reverse mortgage. Origination fee has changed as well. That has been cut down to a percentage of the amount of the value of the home. So I'll give you a good idea. If your house is worth over $600,000, the origination fee or points is limited to capped at $6,000. But what do you think about using a reverse mortgage, or have you used a reverse mortgage like an annuity? Because a reverse mortgage can give you a lump sum, which I don't recommend unless you really need to. Line of credit, which this is what I normally recommend, or monthly payments.
There might be a situation where that fits. I just don't see that myself personally, because every financial decision is not a perfect one. And so I like to go with a line of credit because I want the ability to be flexible if circumstances and situations change. And that's the nature of planning, is to understand the uncertainty of life financially and physically, and be able to deal with those changes when they come. So you're not going to have that flexibility if you turn the reverse mortgage into a fixed income stream.
Well, when I first started in 2004, I believe it was now, it's over 10 years, most of the people, the rates were really low, values have gone up, and I had gotten many, many calls from people that had a reverse mortgage in the 90s and early 2000s, and they wanted to refinance.
Yeah.
And I never even knew you could refinance. So, yeah, you can refinance because now you're 5 or 10 years older, the value's gone up, and they can borrow more money. And so almost all of them had a monthly payment plan. So I asked them, why did you take a monthly payment plan versus a line of credit? They said that was the only option that were given.
Yeah.
That's the way the reverse mortgage was sold in the late 89 and 90s and early 2000s.
Was that true back then?
Yeah, that's what I heard. Because
okay.
I've talked to many, many clients that refinanced. But they were able to get more money out because the values went up over the last 10, 15 years.
Yeah.
They're older, so they get more money, and the rates went down. Rates, remember, if you're in the 90s, were higher than they were in 2000. So very important. But I tell people, when you look at the monthly payments, that is guaranteed you by tenure. In other words, that monthly payment is guaranteed to you for the rest of your life, or what's called term, where you want it for a fixed amount of time, whether it's 5 years or 10 years, or they can say, Percy, I want only $3,000 a month. Well, I can calculate out how long that's going to last, but when that's gone, that's gone.
Yeah.
And plus I tell people, let's say you take out the tenure, it'll give you, let's say, just for talking sake, it gives you $2,000 a month for the rest of your life. Well, in 10 years or 20 years, you think that $2,000 a month is going to be enough to live on? Probably not. Well, here's a bigger thing.
You just lost the whole benefit of the credit line growth.
Exactly right. And that's, you read my report about. Because when people look, and so if you're listening, if you're looking at the payment with a 10-year or term payment on a reverse mortgage, which isn't a bad thing.
Yeah.
It's good if you have a lot of reserves. But here's the deal. When you take a 10-year term payment, it locks up the line of credit, so you lose that credit line growth rate. Now, there are people, well, you can take a blend, put $200,000 in a line of credit and $100,000 in monthly payments. Well, that works for a certain extent, but why not just take the line of credit? Because that credit line growth rate right now is a minimum, I believe, 3.5, 3.75 minimum growth rate per year. There's no place they can find a better appreciation than that. So anyway, that's very, very important. In terms of closing costs, there's what's called a HECM, Home Equity Conversion Mortgage, the Saver, which is a prominent product today where we've did a extensive surveys and research in the last 3 years. And HUD came out with a new product last year, October. You probably heard about it, October 2013, where they did limit how much you can borrow to 60% of what you qualify for, not what your home was worth. And then what they did was they said, okay, if we're going to limit how much you borrow, we're going to limit the closing costs. So what happened was if you take out less than 60% of what you qualify for, they reduced the mortgage insurance upfront premium from 2% of the value to 0.5% or 0.5%, which is reduced the closing costs almost to a regular mortgage payment, a regular mortgage closing cost. So it's very important that people want to realize that, yes, there's some upfront closing costs more than a regular equity line, but the benefits are huge because it's not out of your pocket. It's only equity.
Yeah.
I was in fact, let's talk about CPAs. I was training a bunch of CPAs about 3 or 4 years ago, and I own full disclosure. I always tell people, listen, there are closing costs. Yeah, Percy, I heard it's a lot. I say, well, it is more than a regular mortgage, but today it's changed. So it's still more than a regular equity line. Equity line, I think you can get away with 300 to 500 closing costs. That's it. Sometimes zero, and your closing costs can be 10 or 15,000. I said, well, yeah, that's true, but it's not out of your pocket. It's out of your equity. So I tell people, well, you can get a reverse mortgage or you can get a regular mortgage. The difference is, if you can't make the payment, what's going to happen? So this CPA goes, well, we can just sell the property. I said, did you talk to the parents? Well, they can move in with the kids. Did you talk to the kids? Mm-hmm. So it doesn't give them that option. And so the difference, let's say the difference is $10,000 in closing costs. Is that how much your quality of life is worth? I told the CPA. He goes, okay, good point. But it's true. When people look at closing costs, that's just a finite number right now. Yep. 10 years from now, 15 years from now, that's going to be irrelevant. Yeah. So I always tell people, when you look at the reverse mortgage, it's not about the interest rates. It's really not about the closing costs. It's about, do you want a better quality of life? And this might be a good time to start planning about down the road because, to me, I think when you look at the reverse mortgage or any kind of a situation as you get older, two things are very important to you. And I always ask them, have you got your long-term care plan? And the second question is, do you care what your kids get, what they inherit, right?
Right.
So, so from a financial planner's point of view, Michael, when you see somebody that maybe is taking more than 4 or 5% of their portfolio out, or they're struggling to make a mortgage payment, or they come to you and say, well, how do I fund my grandson's college? How does that conversation start about maybe having the reverse mortgage or an equity line as an option?
That's a good question. And again, it becomes one of the tools we consider. So in that situation, we will have a conversation. First and foremost, the reverse mortgage is having access to your home as a part of your retirement income for the rest of your life. So you're either going to have it or not have it. If you're going to use your nest egg and take out more than the golden rule of 4%, we say that there's a likelihood, a probability that money will deplete in your lifetime and you can run out of money.
Mm-hmm.
So then the other thing is, I want to help my grandkid with education. Can I afford to do that? That answer has to be, and also, what if you live to age 95, and also if you need long-term care? So sometimes when you bring in the way to borrow the money, the reverse mortgage makes more sense than giving your nest egg away or financing it with a home equity line of credit and so on. So in the context of the big picture, can you still take care of your basic essentials, your lifestyle? What if you get sick? What if you die? And then what do you want to leave the children when at the end?
If they care to, because you'd be surprised how many people I talk to say, the kids are professionals, they have their own home, but they really want to make sure mom and dad have a good quality of life.
I think that's what I've been hearing. That more and more I hear baby boomers talking about their parents that I'm helping, and they said, number one, I want my parents to be okay. That's the number one. Mm-hmm. And so the key is to bring the whole family into the picture, because then they understand the trade-off. And again, choosing between the trade-offs, they're going to choose living versus dying.
Absolutely. Well, I hope, when people, as you guys know out there, all of these shows are archived on our website, generations808.com. We also have it actually housed on our babyboomershow.com website as well. And what I want people to understand is that, if you're not sure what to do, you can give us a call, listen to the show over and over, and then ask for specifics. And I recommend everybody, I was telling you earlier, that meet somebody in person. Don't just talk about it over the phone. I've had several people call me. I know a lot about the reverse mortgage, but let me just ask you one question, and it's typically about the closing costs. I say, well, that's true, but have you ever thought about long-term care? Have you thought about what your kid's going to inherit? Mm-hmm. Oh, no. Well, that's part of the decision-making process with the reverse mortgage. So anyway, Michael, as a certified financial planner with Ameriprise Financial, if they have questions, how do they get a hold of you?
952-1240, my phone number.
Thank you, Michael. My number, if you want to give me a call, 234-3117. And we talked about the reverse mortgage, the different options, different things to look at. Like I mentioned earlier, we very strongly look at, as you age, you have to look at long-term care and talk to your kids about what they're going to receive and as an inheritance if that's important to them. Answer those two questions, and I'll tell you whether the reverse mortgage is right for you now. Anyway, I am Percy Ihara. As you guys know, I am the reverse mortgage guy, but I'm also the publisher editor of Generations Magazine and this Generations Radio. Anyway, we always talk about living well, and we trust you have a great time. And please drive safely and have a great weekend. Aloha.